Well, thank you very much, guys. We have a very interesting conference today to come with very, very, very important people in the industry. And as a very interesting thing is that we have both sides. We have the mining industry per se, represented by John and Forbes, mining companies that need the financing. Javier on the other side, who is the one who represents the people that provides the funds, the financing for the industry. So it's going to be very interesting, the point of view of both sides. And myself as a lawyer who always is involved in this kind of things, because we have to secure the transaction for both parties. Sometimes warranties are required, so we have to make sure that warranties are properly put in place for the banks, but also suitable for the companies. Not only is to have the perfect warranty. A perfect warranty is the one that does not disturb the operation of the company. So let's get started. And guys, I have some I would call subject questions for you. And the first one is I would like to start with Forbes, then Javier and John. How will the development of traditional and alternative financing options that are available to mining companies influence their financing strategies and decision-making in the coming years?
If you think of traditional financing, so call that debt and equity. And then alternative financing, I suppose, has been these new sources of capital. So things such as royalty companies, streaming companies. I suppose you could also include things like convertible debt and other sort of non-traditional products. And they're the products that really emerged over the last sort of 5 or 10 years or so. So look, certainly those new alternatives give more options, but I think they also give more complexity too. And I think it's critical for any company to really understand the cost of capital for each of those different options. And so if you consider traditional debt, so that obviously puts a more hefty burden up front on the cash flows of the mine, but once it gets paid back, then the cash flow ultimately flows to the company, whereas a royalty takes less of a burden up front. It takes a smaller burden, but it's over the life of the mine, and that's typically applied to exploration if there's new ounces discovered as well. And so it really is making sure you run the ruler and do the numbers on those different sources of capital to work out, okay, which is the most efficient from a cost of capital point of view. Our project, for example, Cordero, is a very long life mine, plus 20 years. And so maybe the royalty will be expensive over time. So maybe a traditional debt may make sense, but each project's different. But I think with that added complexity, it's really up to the management teams to understand what the options are and what the ultimate cost is.
Thank you very much, Forbes. Javier, what do you think about this traditional and alternative financing, what we have now?
Well, I think the first thing I would say is that even though the prices of the different metals and precious metals have gone up, it's my feeling that there's not lots of alternatives. Of course, there's a few projects that they've been getting financed, but I would say that single asset projects in junior mining companies, they keep struggling really bad. And so then going back to Forbes' point of view, it's hard to plan, it's hard to be strategic in how are you going to finance a company since there's not lots of alternatives, no? And we all understand that we have to balance dilution against getting funded and preventing future cash flows to be given away because of royalties or streams. So I guess it's our belief, no, at the bank that I run, that first of all, we live out of our reputation as a mining financing company. So having said that, we try to be fair and try to balance the three options that are available, which means equity, debt, and royalty stream, no? So all the different transactions, as the one you suggested offline, that we were happy to close the transaction together. We finance it through equity debt and a stream, a silver stream. And I guess the way I feel, because sometimes I'm on the other side, like being a shareholder on a mining company, my feeling is there's not lots of options. Of course, for the big caps, for the big mining companies, they do have the ability, for the Justras of the world, they do have the ability to finance transactions. But I guess for less than $50 million market cap is extremely difficult, no? So I guess that the way I would say is that it feels awkward that even though the prices of metals since last time we jumped on a panel like this, maybe last year, that they were 50% up, I have not seen the financing monies flowing into the system, no? So it feels pretty weird, and it feels like, in a way, worrisome that we have this run up in the prices, but then financing is not still available, no? I guess just going back to the strategic of how to preserve or how to manage the mining companies, I think it's very important that we keep a low cost operation, that we find a way to always preserve cash, because you don't want to be in a position that the market smells that you're running out of cash, which at the end that will bring massive dilution at low prices, and then you might be forced to take streams or royalties just to keep the company running, no? So I guess it's a tough question, because based on the way I believe the ecosystem is performing now, it feels the financing opportunities for the last 10 years, basically, they've been gone.
Sure, yeah. And it's been always, not always like that, but as you mentioned, it depends sometimes the size of the companies, not the structure, the good assets they may have, that they can find solution, which is getting access to the financing. But for those junior small companies is very, very difficult, you know, and it has been forever. And of course, the alternative financing for those companies is, to me, also difficult, because since they don't have proven reserves, it's going to be difficult to have, well, number one, streaming impossible because they are not producing. Number two, they haven't gone through all these parameters, proven parameters as reserves and things like that. It's going to be difficult for them. How about, John, what do you think about this development of traditional and alternative financing?
I think what's happened since the global crisis in 2008, that's almost closed the door for the juniors. The larger companies will always get the debt and equity. They have the way to sustain themselves, right? So the juniors, fortunately, have been given alternatives, which is the streaming or the royalty and equity. And I think that what the juniors have to consider when they look at the financing options, apart from trying to minimize shareholder dilution, which should be at the heart of all discussions, it's the ultimate responsibility of the directors never to jeopardize a project because of project debt and defaulting on payments. And I know it's a challenge because my background's in banking and finance, etc. So I've been on both sides of the table. And it's one where I think that juniors will have to move along. The streaming, the royalty, a combination of equity. And although debt is a viable alternative, it has to be of a size that can be easily managed, because that's the last thing a company wants to do, is to find itself in a position it can't pay the debt. And then unfortunately, the bank has to take it over, and there's a lot of sort of miserable shareholders, etc. So I think that traditional debt it will be used less and less by the smaller companies. And certainly on the royalty and the streaming is much simpler, less complicated to put into place. There is also another alternative financing that has been offered to Sonoro, which is basically an EPC company provides the EPC services all the way through. It's subject to there being performance guarantees, which is good for a junior, probably a little bit more expensive, but the EPC companies, if they can come forward with providing the financing and or arranging the financing, it does become a third alternative, which we at Sonora have been presented with. We're not looking to pursue that route because we believe we have the competence within the company to operate ourselves. But in presenting this, that is something which a junior company should look at. But of course, then it comes down to who is the EPC company, their competence, and whether they can bring financing. So I have sympathy for the bank and I have sympathy for the juniors. And I would say that the responsibility that we have at Sonora is always trying to find a balance between dilution and risk, reward, etc. And so we are striving to minimize the capital in order that we and the lenders can be more comfortable and that we can actually repair. Now that means, of course, costs are included in the operating, but I'd rather suffer the operating reduction in revenues than risk the property.
Right. Thank you very much. How about, can you extend a little bit more on APC for those that are not familiar with this?
Well, engineer, procure, and construct. It's where an engineering company will come and a company that is very competent, obviously, that they can provide a contract where they would sign up with a company. They will actually engineer, procure, construct. And very often when those companies come in, and if they're successful in what they do, the junior company will probably find that they'll be employing some of the former EPC company employees to run the operation. It's relatively straightforward.
Okay, okay. Thank you very much. Yeah, I believe that again, as I mentioned before, it's a challenge for the industry because definitely it is impossible to get all money out of investors at the stock exchange or private placements. So definitely third parties' money is needed, or third party needs, no, such as the streaming agreements.
Mm.
And I don't know who can tell me how often do you see these new finance alternatives coming to the table for the mining companies? It's have you seen it more and more? Because I do remember 10, 12 years ago when we started to have those streamings, not many people even understood what a streaming was. And they were very concerned at losing control of production because they are offering the future production and things like that. But I don't know how common that, for example, your investors see, which they will not be diluted because this strategy is completely different. How they accept these new ways of finance the companies. How about you, John?
Well, I can only speak, say, for Sonora, and that we have been offered royalties and royalty arrangements. And again, it always comes back to a balance between risk and reward.
Okay.
And that's what it's going to be a balance. And each company is going to be separate. But I do think that this is the way that a lot of junior companies will move forward. And there are more companies out there which are having a combination of equity and royalty or streaming. And that's because the concern that they would have that they do not fall foul of any debt repayment structure with the bank. But it's not easy. It's not easy. And then in the long run, a company may elect, they would rather go through the dilution, which is not good for shareholders, than to have a debt or give up revenues.
Yeah, of course. Yeah, the royalty is a direct impact, to the revenues of the company because you have your capital distributed among 100% shareholders, but now you have a third party receiving 2-3%, which was going to be distributed among them, right? However, this is kind of a delusion. Even though you don't lose control over the company with those 2-3% in the shareholdings, you are losing definitely that part of the revenue. Forbes, what do you think about how often you're seeing in the industry all these kind of new structures?
Yeah, look, these royalty and streaming companies, they're here to stay. I mean, 10, 15 years ago, there was 3 or 4. You had Franco, Royal Gold, Silver Wheaton, but now there's probably 15 to 20, probably more. And look, it's a nice, simple model from their point of view. They have very low operating expenses. They cover their corporate G&A. They get exposure to the commodity price. So they got spectacular margins. And by sort of leveraging their own balance sheet, they're able to give it a very competitive cost of capital. So no doubt they're here to stay, and they're going to be a sort of financing option going forward. And it comes down to John's point about, you know, each company's got to value their own project and have its conversations with its, at least from looking at the shareholders' perspective too. And I mean, our 2 biggest shareholders, one is Eric Sprott, he owns about 25% of the company, and then another one is Merian, they own about 10%. They're both very bullish on the silver price. And so for us to sort of go out and sell a silver stream and give up some of that upside on potential silver price increases, I think there would be a lot of hesitation there on their part for us to do that. So but at the same time, we as a company, we have to look at the sources of capital in front of us, and hopefully there's enough down the road, equity and then traditional debt, and the project will be able to handle that debt, as John referenced, to perhaps not go down that route. But they're here to stay. They offer a competitive cost of capital, and it's certainly a part of the equation now and will be going forward.
Good. I represent some royalty companies like Franco-Nevada, and definitely what I can tell you is that the last, I would say 7-8 years, it's been increasing lots, our services to the royalty companies to structure these royalty agreements. And because, you know, it's a big amount of money coming from the royalty companies to the projects, which is very good in terms of having the opportunity for the companies to develop the project, no? To increase the size of the project, or to finalize the plant, to increase the plant, etc. So I do believe that these new alternatives are definitely good if you can definitely plan properly with a good strategy the continued growth of the company in order to prevent those 2-3% given to the royalty companies, not to impact very much in the investors, I would say. No, if that happens, I believe that it's between the traditional way of financing companies and this way would succeed. It's my personal view. I don't know, Javier, how do you see? You guys are doing both already, no?
Yeah, I guess we do everything. We do equity, we do all kinds of debt, we do mezzanine, we do construction loans, we do convertible debt. We do what we like the most is debt with warrants, no, which is where we are mostly active, and we do as well as stream and royalty. Yeah. So I guess in a way we are one-stop shop. But the way I would describe, because it's different when you are because I'm on both sides most of the time. If I have to use my bank's hat or my financier's hat, of course you want to maximize returns, no? And you are gonna push, and depending on the cycle you are going through, then you have to be more strategic, no? And let me explain myself. And also, well, I would say that I've been doing this for 20 years, and my idea is to continue doing it for many more years. So you have also to take care of your reputation and not being a kind of financier that you are lending to own, or you are basically bleeding the companies so that they don't have any incentive to push the projects forward, no? So having said that, I think it's also a matter where in the cycle we are, no? So the way I feel now, and again, mostly my bandwidth is my expertise is investing in publicly traded companies with assets in Mexico, no? Because mining is already extremely difficult. And at the end, Joan, myself, Enrique, we're Mexicans, and I don't know if we know how to navigate our own country, but at least we can do it better than foreign nationals. So if you combine the foreign expertise like John and Forbes with our local knowledge, for me, that's a good combination. So the way I feel now, and most of the transactions that we have done lately, it's been mostly restructuring. So the last really bad cycle that we have had, and sometimes it feels that it's always bad, no? But the last many years, most of the companies have taken loans, very expensive loans, and many of them have taken loans from off-takers, no? So the off-takers have given all these mining companies millions of dollars just to get the offtake, but now they sit on the balance sheet with defaulted loans, no? Which for market purposes, it looks pretty bad. So what we've been doing is restructuring, no? And doing, again, that with warrants, no? So I would say that John is very right in his comment in you have to balance the risk, no? Because the shareholders, they're always bitching about dilution, no? But sometimes they bitch, but they don't write the check, no? So in order how to balance that is if you take all the debt just to prevent dilution, then the probabilities of going broke, of course, increase in a bad side, no? So I guess what I see is that now more than ever, there's lots of royalty streaming companies, and what it happens is when you have too many companies pursuing a specific niche, then you start bringing the prices down, no? So I think it's very smart on the royalty and streaming side to compete. In Mexico, for example, I know at least maybe 30 royalty or streaming companies. So then they start fighting against themselves, which is good for mining companies because start bringing the cost down. In terms of financing, I see there's no appetite. I mean, we like the $10 to $20 million, but I don't see any appetite below 50. Above 50, of course, you have the Scotias of the world, the BMOs of the world getting financing. So I guess it's a tough question, and it will always depend on which part of the cycle. Because if the cycle was booming, like we had many years ago, of course, it's better to print shares and not have any balance sheet risk. But I don't think we are there, and I don't know if we're going to get there.
Perfect, guys. So I'll move forward to the next question, which is, what are the critical success factors for investing and miners in allocating and accessing financing in today's mining industry? And I would like to start with you, Javier, if you don't mind.
I guess for me, the only way to succeed is basically management and being hands-on, no? So you have to invest. When we decide to invest in a mining company, the key factor will always be the management, because they will be responsible for the success. And most of the time, you will finance the asset itself, but the management that will make it happen. So for me, the most important thing will be always the management, the asset, and of course the jurisdiction, because mining is getting hit all over the world. Even in our own country, I don't think it's the most famous and fancy investment, mining, and it's getting difficult. So that's the way I would answer, and be always hands-on, be depending on how big you invest, to be represented at the board level, and fully follow with your fiduciary responsibility. No,
I believe that sometimes we don't believe in management. No, I mean, we think we have a good asset, and that's going to be the perfect key to access the financing. However, I believe that we still have the human being running the companies, and a nice and good trained group to manage these companies may bring very, very good success in getting credit. That's my point of view. And I have seen how well-organized companies access much better than those that are struggling with the organization of the companies. John, what do you think?
I think the comments that have been made so far are very accurate. I would just add that in addition to having a very competent management team, an experienced management team should be the level of ownership that the management has in the company. There's nothing greater to drive management to success than having an ownership in the company. And I think that's also reflected in the shareholders' interest in the company. In Sonoro, for instance, we have about 20% of the shares held by management, directors, staff all the way through. And these are not free shares. They were purchased, they're all at the same price, around about 19, 20 cents a share. So that works both ways, I think, in that it demonstrates to the investors and to the lenders, whether it's a traditional bank debt or royalty or whatever, that the management is fully engaged. So I think that is a very important factor to come in. So there is the competence, the expertise, and also to make sure that the management have a very diverse and complementary skill set. Having a mining company that's run by geologists or engineers or bankers or IR people is almost a recipe for disaster. So you need to have that broad band of knowledge, experience, and commitment and ownership. I think there's another part that comes in there as well, is that in moving forward is how many times do you see a smaller company where the management is involved in about half a dozen companies? And so that to me means there's a lack of focus. And again, I can just refer to Sonoro and say that Sonoro is the only company in which we as the group are fully involved. So as the senior management team there, each of us have at least 35 years experience and successes in successfully developing an operation. So from a lender's point of view, from royalty or whatever, nothing is better than the previous success. You know, that's really to take into consideration. So I think that what's been said is correct. I think the environment is a major factor in which you're working. In Sonora State, we think we're in a very good location there, so we're happy with that. Obviously, a robust return on investment is a critical factor to look at. And there's also an additional factor, which is, I think, another part of our discussion, but very important, is the environmental, social, and governance concerns. More and more, I think lenders are being aware of this, companies are being aware of it, the understanding that shareholder action and whether it's the EPA in the USA or wherever it may be, companies are going to be held to account now. So bringing all those things together, I think, will dictate the success of a company.
Okay, thank you. How about you, Forbes? What do you see these factors, that could be key to access for the financing?
Yeah, look, I think John and Javier have sort of touched on it quite well. And maybe a different way of putting it is the most critical success factor is risk management. And part of that is managing social risk, managing environmental risk, managing the technical risk, the execution risk. So that speaks to Javier's point about having a good, strong management team that can manage those risks. Then also the asset itself, the commodity price risk. Okay, if you've got a low cost asset, that's going to have a natural protection to fluctuating commodity prices. And so, but the better you can manage those overall risks, obviously, the more confidence a lender is going to have on the return on its investment, the more aggressive it can price its loan, and ultimately the lower the cost of capital. So, so I think, yeah, it sort of touches on all the points that have already been discussed so far. And even from our point of view at Cordero, John alluded to this about managing the size of the project, and we're looking at stage expansions of our project. So rather than building the big mill up front for the big heavy capex number, we're going to start the mill at basically half its ultimate throughput rate. And that way the upfront capex is much more manageable. It means we're putting a lot of less pressure on the balance sheet, so lower balance sheet risk, then ultimately funding the expansion of the mill from the cash flows of the mine. So I think it's sort of, that word ties in quite nicely with all the other sort of themes that John and Javier talked to as well.
Okay. Yeah, I think that you guys cover, in my view, everything. these key factors, I would say, are taken into consideration by banks and lenders, etc. But I would say, probably the three of you may agree with me that if you want a success company, you have to put all these together in a machine and making sure that everything is complete, that you're achieving this and this and this. And it depends, of course, the way you do the business in order to obtain first this part or the other. But I believe that a successful company will always be much more close to the financing than a company that is not successful. And to have success not necessarily is to have the best grades, because it's the nature that gives us the grades on the asset, but the way to do it and the way to manage the company and the way to be accepted in the community and the way to be accepted with the government and compliance and all these things. I believe that when I run the due diligences for the companies requested by the company or requested by the bank, with my group of lawyers, we sat, and when we have all the findings and we say, it's going to be difficult for this company, or wow, this is a nice company that shouldn't have any problem, the bank, to review and to understand how they work. And I have been including things in my due diligences that probably, I don't know if you take into consideration when you are thinking about financing your companies with banks and all this. But one of the things and questions that I included is things about the security in the area, and the behavior in the area and how people accept the product. Probably you both, John and you, said something about it. But I don't know. How do you see that part? That part that seems to be not yours because it's the community, is third parties, but you are the one that build the relation. What do you think in that regard?
Yeah, look, I mean, there are those risks that are certainly out of management's control. And so, look, that is the nature of the mining business. You don't get to choose where the deposit is. And ultimately, if there is that elevated risk, then companies like Javier's are going to look at that and then price in that risk margin on the capital they're providing. And so certain things can be managed, but certainly things are sort of certainly out of your control. And I think what we can do as management teams is do our best to manage the stuff that's inside our control. And yeah, the stuff that isn't, then that obviously, depending on how elevated a risk it is, will ultimately impact your cost of capital, but that's just going to be part of life for that project, right?
All right. So I'm going to move forward because we already have one question from the audience that we'll see if we have the time enough to answer at the end. So the following question goes. I would like to start with John, then Forbes, and then Javier. Which debt and equity financing options do you expect to be most prominent in the mining industry in the coming years? Which role will alternative financing options play?
I think we covered this quite well at the beginning, and so it's a matter of just repeating it. And what's going to be more prominent is as the bankers look at a company, they will look at it as its size and the risk. The bank takes the same view in terms of risk reward as does the company. And so a smaller company, startup company such as Sonoro, will not have the ability to secure the traditional debt or equity, and therefore with the larger bank that is. And then with the alternative banks that provide that, it depends on how the risk is there. Because as I said, the ultimate risk to a company is to lose a project, getting involved in a debt structure where, due to circumstances beyond its control, be that metal prices decline or other factors come into play, there's a social reason why production is halted, and it then becomes a risk. So moving forward, I believe that there's always going to be that trade-off that the management has to take into consideration, risk and reward, diluting shareholders and increasing the risk of default for project debt. Therefore, it almost compels company to either accept equity and face significant dilution, And then you end up with 350, 400, 500 million shares. And that doesn't sit well with anybody eventually. Or to look at the royalties. And so I think that that's where we're going to see most of things working for the smaller companies. The larger companies will always get debt and equity. You know, that's not an issue. So the smaller companies, say in Mexico, emerging companies such as we are compelled to look at a combination of equity, royalty, bank debt, but always in our minds is that we balance the risk and reward, and always have that, never to put the project into jeopardy. Because as much as last year in August, gold was predicted to go to $2,000, $3,000, $4,000. Everybody says wonderful. It didn't take long to get corrected down to 1,600 and something. So silver may be doing well, and everybody's bullish on silver. And I can go back in my life and see people are bullish on copper and every commodity you can think about, including tin. So moving forward, I think that the junior companies will be looking more and more to the alternative sources, as we spoke before. Royalties, small bank debt, manageable, and unfortunately equity.
Okay, all right. First, I don't know if you want to add a comment on this. Otherwise, what I would like to do is the following. It's going to one question from the audience. First, please.
Yeah, sure. No, I think we have sort of touched on all those aspects before. So why don't we jump to the audience question?
Thank you. And we have another one from our questions, initial questions, but I think that this question, it's good now, which is interesting. What do mining investors need to be sure of wanting to invest in a new project? What do you think about that?
Yeah, it's a pretty open-ended question. So look, I mean, what do they want to be sure of? Like I think, you look at our project and where we're at, and for us, we really have two levers in terms of how we can drive value. And I suppose that's what really investors should be focused on if they do want a return on their investment. And our two levers are ultimately driving and increasing the underlying value of the project, so the net present value of the project. And the second lever is de-risking the project such that we're going to get a higher multiple applied to that value of the project. And so, how do you increase value? It's usually through the drill bits, increasing the number of ounces, getting new discoveries and whatnot. I know we've been very active drilling. We've drilled 100,000 meters in the last 18 months and had a lot of sort of very good drill results. And when we put out our economic study, we're going to articulate the value of the project by showing what the cash flow potential is. So that's one clear lever that investors should be looking for: is the company moving its project forward? Is it adding value? Is it de-risking the project? Because outside of any movements in the commodity price, they're ultimately the two levers management have in terms of sort of how they can drive value. So that really is probably where the investors should be focused on, what our management team's doing to really drive those two levers.
Okay, I got you. I don't know, what do you think, guys, but looking at a project and a company and there's an opportunity to invest there, do you think that it's much better to go through the opportunity of a company that already, for example, obtain a loan from bankers, which bankers already done their work on due diligence, not only the company, but the property, etc. What do you think, John? That helps, having already gotten a credit?
Undoubtedly. Having a bank be willing to fund a company is a good indication that the bank's not just throwing money away, and that it indeed has done its due diligence. There are unscrupulous lenders who would lend too much to a company for the sole purpose of acquiring it. And I'm not suggesting that's the situation today, but in these factors that we talk about, investors, investors get drawn in it for certain reasons. When gold price goes up, copper price goes up, silver goes up, so therefore we get to invest. And often that the more quote unsophisticated investor, and I'm not being disrespectful, they become motivated by visions of what it's going to mean. But the serious investors, I think, do not look at one factor; they look at all the factors. And one of the things that we say about Sonoro is that we have the 5 essential components to be a successful company. And that's why I believe we've attracted so many investors and why our share price moves against the trend and we get more and more interested. Because if you consider it, and certainly I'm absolutely certain the bank is considering this at any one time. Who are the people? Are they diversified? Are they complementary? Are they competent? Have they done this before? Are they novices? Are they promoters? So the people, the paramount importance, the project itself. And then that comes down to obviously the geologists. Are they competent geologists? Have they proven? Have they been successful before? So the answer can be yes on that. Then it is the matter of what is the share structure? What does the management own in that company? Are they just guys who are just taking management fees or directorship fees? But if it doesn't work well, that's the way it goes. Or will they actually suffer personally? Personal investment is a great motivation. And then beyond that, I think, is does a company have a clear business plan? And again, I think these have been developed within me because I had so many years on the banking side, investment side. And whenever anybody came in, if they didn't have the answer to all those questions, I was very suspicious. If they didn't have a detailed business plan, for instance, we have a very detailed business plan and an execution strategy. And so we have, I'm sure like most companies do, we monitor things very, very closely. And so it's a matter of doing what you say, not just overly promoting. So I think from an investor's point of view, they should look at all aspects, the 5 that I've just mentioned. And if you can tick the boxes off on those, there's a good level of investor interest out there. And I think where it falls down sometimes is when people do not understand that you need all of these components to be successful. If you're moving forward, but you have no business plan, if the management and the geologists have never done it before, or if the capital structure is such they have no ownership, if they don't have a history of raising funding, each one of those are very high risk elements. So the more boxes that can be ticked, I think the more attractive it becomes to investors and to bankers and lenders.
Okay, sure. Javier, I know you've been in the past a very active investor. So what do you think? What do you see? What are those things you focus more in taking decisions?
Well, just adding to what I previously said, something very important is the skin in the game. No, like John Forbes were saying. No, you don't want somebody just collecting fees just for the good sake of collecting fees. You want to have somebody with skin in the game. No. And of course, you want good management. You want the insiders to have something to lose and not just there for their salaries. And then on the institutional side, I think it's key that you do select the right investors and the right bankers. No, you want somebody that can manage, that has I would say a stomach to manage the bad days, which in mining there's many bad days. And if you have a blockade, if you have a really bad market, you want to have smart people behind you that can support you in good times and bad times. No, so I would say that when we invest, management is key, the asset is key, the jurisdiction is key, the balance, risks, and the skin in the game, but also that the investor base and the lender base, all the institutions financing the different mining opportunities, you can work with them in the bad times, no, because that's when things get pretty messy, no. So I think it's key that those either funds or institutional investors, you want to have retail investors, but you as well have to have, good investors. And also, I guess after, probably as John and Forbes were saying, no, after so many years in this industry, you get to learn how it works. You want to get out of these over promoted companies. You need to sell, you need to promote your company, but you don't want these pump and dump guys into your capital structure and then they're them cashing out for the 20-30% and then leaving you away. No, I guess it's pretty sophisticated if you want to do a big and good investment, but you have to take many angles to make the opportunity successful.
Thank you. You know, it's interesting because with that you can take an educated decision, and this is you know, the typical thing in our industry that I do remember back in the 90s. Here is a great opportunity because this project is marvelous, and you see it neighbors with this huge project and all these things. And after 10 years, you see nothing there, but lots of money lost by investors, right? So guys who are listening to us, it's not only the project, it's a company, and the company is compounded by all the things that these people, experienced people just told us. So I think that what we learned today with you guys, it's marvelous. Thank you very much. I'm going to tell you the last question. I would like Forbes to start answering, then John, and close with Javier. And the questions from the audience, I believe that we already touched all of them. So, but this last was very interesting. Thank you, guys. Which role does a company as ESG strategy and track record play in accessing financing in the present? And how do you expect this to evolve in the future?
Okay, so it plays a very important role, and I think moving forward it's going to play an even more important role. And through the effective management of ESG, that does two things. One, it lowers the overall risk profile of the project and the company, and we sort of touched on that. If you manage the social risk, you manage the environmental risk and the governance risk, you know, that creates a better platform overall to then go out and try and finance the build of the project. So that's the first thing. And I think the second thing it does is it actually opens up a lot more sources of potential capital. And that's only going to increase. You know, certain investment funds now have to have, will only invest in companies that meet certain ESG thresholds. And I think you're going to see more and more of that, and especially the big funds that obviously represent retail investors or other institutional investors, whatnot. They'll only be allowed to invest in companies that have very high ESG standards. And you probably see a little bit of that on the lending side too. That'll be interesting to see what plays out, but certainly government organizations like the World Bank, they obviously have a very high bar in terms of what they want to see on the ESG side before cutting a check. So I think it does those two things, and yeah, it's important. It will continue to be very important moving forward.
Right. John?
Well, I can't argue with anything that Forbes has said. He's absolutely correct in his summary. I'd like to add a little bit, though, to this here. The importance of ESG, I can reference this because I had a lot of exposure to this on the positive side in a separate sort of private venture where this was very important with a community of very, very poor people. And so the environment, we understand. The necessity to do that. I think the global warming has brought greater and greater attention to that level. The need that the demand is put on a company by its major shareholders and also by its banks who want to make sure that they're not going to be exposed to any excessive penalties by governments, etc. So the environment is very important. Governance, of course, is significantly important as well because it's all to do with transparency, ethics, ensuring that there's no corruption or bribery or whatever. And what's happened as a result of social media now, everything is out in the open. Whatever happens today can be reported around the world within about 1 minute. And so people become very much aware of that. So governance is important, but the social part as well, I think, has a very important part to play in companies moving forward. And it's understood that a company which has healthy and happy and content employees is going to be a much better company. And therefore, you can expand that further and say that the environment in which they live. So if you're taking care of the social side to the community, and it's seen by the government, by the employees and the community, that it's not just lip service, there's actually contributions, etc. The difference that it makes. And in that regard, if you have a healthy employment, fair wages, and a development that actually will reward the company in the long run. And I think shareholders are looking more and more to that to come into play.
I would add to previous question, to whomever made that question, is that you have to see if that company you are looking to invest is in full compliance with ESG, right? It's part of all this. Javier.
I will say that, just adding to what John and Forbes said, rather than arguing if it's important, because it's extremely important, because I think mining were pioneers. Well, mining publicly traded companies, they always been pioneers in fulfilling ESG. No, I think because we've been under attack for many years, we have been forced, even though it was not common to use the ESG word, we have always been forced to be fulfilling our social, environmental, and political government responsibilities. No, so now I guess what has changed is it has become, rather than important, I think it's a requirement. No, so on the financing side, things are changing so that if you want to get funded, you need to have this ESG certification. No, so again, it's important. It's not just for the mining industries, for all industries, and it just as John or Forbes was saying, it's just another way to decrease the risk on all fronts. No, I guess there's no way around it. No, you're forced to get it now.
That's right, and you know, nowadays for us lawyers, it's not only to do our work on looking at compliance with governmental rules, no laws and norms, etc. But also there are others, and this is a good example. No, the ESG. We for example, when we conduct certain due diligence, we have to look at the rules and principles of the International Finance Corporation, for example, no, which those are very much in hands of all banks. So banks, when they lend money, they have to look at those, making sure the companies are in compliance with all these things that are not only things invented by governments, no, are real things the human being requires. No, as you said, John, the global warming and things like that, they are not inventions, are things that are happening. And I believe that if we all work towards doing our work, I would say suitable for the human being, is going to be better and better for everyone. And I think that it is also, as an investor, I would look at a company that complies with those things, because that will give me the certainty that if they are looking at that, it's because they have a good management and because they have invested in all other things, no, to do this. So I would like to have just to close our panel, your thoughts on this and on this panel that to me was very, very interesting, and for the audience for sure, learning from you guys with all the experience you have, it's very interesting. To me, it has been very, very interesting panel. Forbes, can we start with you? I don't know if you want to close the presentation with some remarks or comments.
Look, yeah, I mean, I think it's been a good, healthy discussion, and yeah, the mining space. I mean, I think we've touched on it. It is very volatile, and when you look at commodity price fluctuations, I mean, the equity markets open up, and then that makes it easier on the debt side of things. but then there's sort of long periods where things can be tough. But it is a good space. And look, on the sort of items around ESG, I think it is important to note that there is a lot of investment that goes into sort of the local communities and local stakeholders, whether it's communities and governments, that ultimately has a lot of long-term benefit, and often that gets overlooked amongst all the sort of hype around shareholder returns and whatnot. But there are a lot of additional benefits that come with that, and I think will continue to come now that there's this increased focus on ESG. So I'll leave it there, and thanks for your time.
Thank you very much for your participation and your thoughts on all these. John.
Yeah, for me, it's been a pleasure and a privilege to participate in this panel. And what's impressed me is that we're hearing it from both sides, from the banking side and also the mining company side. And that we have very similar thoughts, if not identical, is very encouraging, because to me that reflects that we're all moving in the right direction. And that's very important there. So it's been an interesting time. From Sonora's point of view, we're really happy where we are. We just have had a full transformation from exploration through development now to near-term production, waiting for our PEA to come out in a couple of weeks, etc. So it's an exciting time, and to be a member of this panel has been quite a privilege. Thank you.
Well, thank you. Javier.
I'm glad to see you again, Enrique. We recently saw each other because of the closing we had, but it's nice to always see you in these mining events. John, we have a neighboring company to Sonora, which is Gold Group, no? And I know our teams have been going back and forth, so we do respect a lot what you are doing. And Forbes, I guess I met Dag, and maybe not you, but I do respect a lot since the old days of the Timmins world when Dag was there. So it's always enjoyable to see friendly people, professional people, and share a panel with you guys. So thank you for having me.
Well, thank you, guys. Yeah. And I would wish a very good luck on your projects in Mexico to the three of you. And I think that we have a nice Mexican mining industry going forward with all the problems that we have every day. But I believe that Mexico is a nice country to continue investing in the industry, which is a beautiful industry. And every time that I talk to people that doesn't know anything about the industry, I believe that we need to educate a little bit more the people to understand what John told us offline. So look around, everything is made out of the industry, and that's right, John. Yeah?